Rezolve AI is currently trading at $2.78 per share as of the market close on March 16, 2026 at 4 p.m. EDT. The stock saw a positive intraday movement of 3.35%, gaining approximately 9 cents from its previous close of $2.69. While the broader indices have been digesting recent inflation data, Rezolve managed to find a pocket of strength, carving out a daily range between a low of $2.71 and a high of $2.85. For a company with a market capitalization sitting around $931 million, these small dollar moves represent significant shifts in sentiment for a retail-heavy ticker. You might look at a sub-$3 stock and assume it's just another small cap struggling to keep the lights on, but the reality is that Rezolve is currently sitting on one of the most aggressive growth mandates in the software sector. The expectation from the casual observer is that this is a speculative play with high burn, but the reality is that the company just closed a massive $250 million financing round and reported its first month of profitability in December. We're looking at a business that is effectively attempting to grow its revenue by 10 times in a single calendar year, and the market is currently caught in a tug-of-war between believing those projections and fearing the dilution that usually comes with such rapid scaling. When you look at Rezolve AI stock, you see a massive gap between where the price is and where analysts think it should be. Some price targets are sitting as high as $15, which suggests a belief that the current price is a radical undervaluation. But why is the market hesitating? It comes down to the sheer audacity of their guidance. Management has told the street to expect $350 million in revenue for 2026. To put that in perspective, they were looking at a tiny fraction of that just 18 months ago. This is the classic tension in high-growth tech. The narrative is that they have solved the commerce problem with their brain suite, but the reality is that they are still a small fish in a very big pond dominated by giants. For those using a Fidelity trading platform or checking their Robinhood app, the volatility in RZLV can be stomach-turning. One day it's up 10% on news of a partnership with Microsoft or Google, and the next it's down 5% as investors worry about the 399 million shares outstanding. This isn't your standard dividend-paying utility. It's a high-stakes bet on the future of how humans and machines buy things. The volume we saw in the most recent session was over 11 million shares, which is relatively healthy but actually a bit below their 30-day average of 17 million. This suggests a period of consolidation. Big institutions are watching this closely. We've seen firms like Susquehanna and other hedge funds increasing their stakes, which usually signals that the smart money sees the $250 million cash injection as a floor for the stock. If you're looking for investment help or exploring various investing sites to find the next big runner, you have to weigh that institutional confidence against the technical reality that the stock is still more than 50% below its 52-week high of $8.45. It has been a rough ride for long-term holders, but the recent floor at $2 seems to be holding firm. The company's move into stablecoin settlements and agentic commerce is what sets them apart from a standard Shopify or Salesforce. They aren't just giving you a website, they are trying to build the underlying brain that handles everything from the search to the final payment without a human having to click a buy button. This brings us to the core of the business model. Rezolve operates what they call the brain suite. It's essentially a three-pronged attack on traditional retail. You have Brain Commerce, which handles the AI-powered search and personalization, Brain Checkout, which is the transaction layer, and brainpowa, their proprietary large language model. They claim this has effectively zero hallucinations, which is a big deal in the enterprise world, where a wrong price or a fake product description can lead to lawsuits or lost customers. They've already secured contracts with brands like H&M, Adidas, and Gucci. The expectation is that these blue-chip names will provide the recurring revenue needed to hit that $500 million exit rate by the end of 2026. The reality, however, is that enterprise deployments are notoriously slow and complex. Even with partnerships on the Azure Marketplace and Google Cloud, getting a global retailer to fully switch their infrastructure over to a relatively new player like Rezolve is a massive hurdle. Institutional activity has been a major driver for RZLV recently. When the company announced they were oversubscribed for their latest funding round, it forced the bears to rethink the bankruptcy narrative. You don't get $250 million in fresh capital if the books are a mess, especially not in a high-interest rate environment. This capital is being earmarked for acquisitions and scaling their infrastructure. If you're a self-investing pro using interactive brokers or managing a Schwab Intelligent portfolio, you know that a company with a war chest like that is in a position to be a predator rather than a prey. They've already acquired Crown Peak to bolster their market share, and more M&A is likely on the horizon. This is how they plan to bridge the gap between their current revenue and that $350 million target. They aren't just growing organically, they are buying their way to the top. The macroeconomic pressure on the retail sector is the elephant in the room. If consumer spending slows down, those AI-powered checkouts aren't going to be doing much work. However, Rezolve's argument is that their tech actually saves retailers money by making search more efficient and reducing the cost of customer acquisition. It's the classic efficiency play that software companies sell during a downturn. Whether that holds true or not is something we'll see in the next few quarterly reports. For now, the stock is reacting more to liquidity and guidance updates than it is to broad retail trends. We're seeing a lot of retail interest on platforms like SoFi Invest and the Robinhood app, where younger investors are more willing to take a chance on a disruptive AI play than the traditional crowd at a legacy Fidelity wealth management office. Let's look at the numbers for a second. In the first half of 2025, they reported about $6.3 million in revenue. That was a 426% year-over-year. That sounds amazing until you realize they are trying to hit $350 million for the full year 2026. That is a vertical climb. They finished 2025 with an annual recurring revenue of $209 million, which was a huge beat over their own $150 million estimate. This is the reality exceeding expectations part of the story that keeps the bulls interested. If they can keep beating their own estimates, the stock won't stay under $3 for long. But if they miss even one of these aggressive targets, the fallout could be brutal. Investors are currently paying for future perfection. If you're watching the Nvidia stock or Apple stock for signs of a broader tech cooldown, you might be missing the action in these smaller AI infrastructure names. While the megacaps provide the chips in the cloud, companies like Rezolve are the ones actually building the applications that businesses use. It's a different part of the stack with different risks. For example, if you're looking at your SoFi active investing account and trying to decide between a safe ETF and a stock like RZLV, you're essentially choosing between steady growth and a potential lottery ticket. Comment below how many shares of Rezolve AI you currently hold, or if you think the retail AI space is getting too crowded for a company of this size to win. Looking ahead, the catalysts are very clear. We need to see the audited financials that prove that December was indeed a profitable month. Profitability is the holy grail for small-cap tech right now. If they can show that their business model scales without needing another $200 million from shareholders, the valuation could re-rate overnight. There's also the matter of their stablecoin settlement system. Rezolve has already processed over $1 billion in transactions through their Brazil infrastructure. If they can successfully port that over to the UK and North American markets, they become more than just an AI company. They become a fintech powerhouse. This is where the reality could significantly outpace the current market narrative. Most people just see them as a chatbot company for stores, but they are actually building a full-stack financial and search engine for global commerce. The risks remain significant. Dilution is the big one. They have been very active in the capital markets, and every time they issue more shares, the piece of the pie for current holders gets smaller. There's also the competitive landscape. Salesforce and Adobe are not just going to sit back and let a newcomer take their enterprise clients. They are integrating AI into their own commerce clouds as fast as they can. Rezolve's Edge is their commerce-native LLM, which they say is better than GPT-4 for specific retail tasks. If that tech advantage holds, they have a moat. If it doesn't, they're just another vendor in a sea of AI startups. When you're navigating online investing, whether you're using a basic Robinhood stock trading account or a more advanced Fidelity brokerage setup, the key with Rezolve is to watch the ARR numbers. Annual recurring revenue is the bloodline of a SaaS business. As long as that number is moving up and to the right, the stock price eventually follows. The current price of $2.78 reflects a high degree of skepticism, but it also offers a massive asymmetric upside if the company even gets close to its $500 million ARR exit target for 2026. This is a classic case of the market demanding "show me" before it pays up. To wrap this up, the story of Rezolve AI is one of massive ambition meeting a skeptical market. The expectation is that they are over-promising to keep their stock afloat, but the reality of their recent cash raise and customer wins suggests they might actually have the goods.